Martha Stewart faced insider trading charges in New York. You might think, how could someone like her get caught up in something so shady? But here's the truth. Martha Stewart's case was one of the most publicized insider trading scandals in U.S. financial history, highlighting the serious consequences for individuals involved in using non-public information for personal gain. Let's start with what happened in 2001 when ImClone Systems stock plummeted after an FDA rejection for their new cancer drug, Erbitux. On December 27th, Martha Stewart sold her shares on December 28th before the market opened. The sale netted her approximately $45,600. The next day, the SEC began investigating ImClone's stock activity due to suspicious trading patterns. Why did this matter? Because when someone trades stocks based on non-public information, it's illegal. Martha Stewart was charged with insider trading and obstruction of justice for allegedly trying to cover up her actions related to selling ImClone shares before negative news affected the stock price. But here's where things get complicated. Martha wasn't the only one selling ImClone shares that week. However, the passage does not provide evidence to support a widespread market crash affecting thousands of people losing their savings due to this specific event. Now let's break this down step by step. Subject: Martha Stewart's insider trading scandal. Step 1. The FDA rejects Erbitux on December 28, 2001. Step 2. Martha sells her ImClone stock on December 27, 2001. Step 3. SEC investigates suspicious trading activity. Step 4. Martha faces charges in a public trial, but why did she do it? Martha Stewart had a reputation as a financial advisor and homemaker expert on television. When the insider trading scandal emerged, it cast doubt on the reliability of her financial advice, leading people to question her credibility in this area. The stakes were high. Martha Stewart faced up to 5 years in prison and millions of dollars in fines. However, many people thought her celebrity status and powerful connections might shield her from going to jail. Martha Stewart went to trial in March 2004. The jury deliberated for 3 days before finding her guilty on 4 counts, including obstruction of justice and making false statements. Now here's the math. How did selling $45,600 worth of stock turn into a decade-long legal battle? It wasn't just about the profit she made, it was about setting an example. Martha's actions were seen as a betrayal of trust in the financial world. She had to pay millions in fines and serve 5 months in prison. But here's another twist. While Martha served her time, her brand suffered less than you might think. People still bought her products because they saw her as someone who could bounce back from adversity. In 2003, her company's stock price actually rebounded after the verdict was announced. So what can we learn from this? Subject: understanding insider trading. First, insider trading is illegal and carries significant consequences regardless of one's status or celebrity. For instance, Martha Stewart faced serious legal repercussions for her involvement in insider trading. Second, appearances matter greatly in the financial industry. When entrusted with clients' funds, maintaining honesty and integrity is crucial. But let's zoom out for a moment. What was really happening here? This wasn't just about one person selling stocks. It highlighted how actions of influential individuals and events within large corporations like ImClone can impact broader market dynamics and investor confidence when things go wrong. Now let's look at the bigger picture. The ImClone scandal occurred during a period of significant volatility in the technology and biotechnology sectors, where many companies faced challenges and investors were uncertain. Martha Stewart's case underscored the severe impact that insider trading can have on eroding public trust in financial markets. Think about it. If you invest money based on information that others aren't supposed to have, you're putting everyone else at a disadvantage. It's not fair and it's illegal. But here's the kicker. While high-profile cases involving celebrities like Martha Stewart receive significant media attention, most insider trading incidents involve regular individuals who do not make headlines. Now back to Martha's specific case. She didn't just lose money, she lost her freedom. Serving approximately 5 months in federal prison was no vacation, and while she was there, her reputation took a hit and she couldn't give financial advice anymore. But here's the thing, her brand recovered faster than many expected. But why? Because Martha Stewart had built a loyal following long before this scandal occurred. Her fans didn't just care about stocks, they admired her lifestyle and sought advice on cooking, home decor, and more. So when she returned to public life, people remained interested in what she had to say. Now let's talk numbers. In 2004, Martha Stewart's company ImClone Systems saw her stock sale bring attention to the firm with financial impacts on her later venture, Martha Stewart Living Omnimedia MSLO. MSLO reported revenues of $135 million in fiscal year 2006, up from just over $80 million in 2001, before the scandal broke out. That's a significant turnaround for someone who was once facing legal consequences and potential jail time. But here's where it gets really interesting. While her personal brand recovered over time, some smaller investors suffered significant losses. They lacked Martha Stewart's resources and connections to navigate through the difficult period. So what does this mean for regular people like you and me? It means that when there are issues or scandals in major corporations, smaller investors may feel the impact more acutely due to market volatility and loss of trust. Additionally, high-profile cases of insider trading can erode public confidence in financial markets and regulatory systems. Now let's dive into some history. Insider trading isn't new. Back in 2004, Martha Stewart's case became a high-profile scandal involving insider information. Her trial was watched by millions of people around the world due to her public persona and media presence. But here's a critical point. Just because something is done by a celebrity doesn't mean it's legal or ethical. The law applies to everyone equally regardless of fame. When someone violates the law, they face consequences. Now let's talk about why Martha Stewart might have felt she could get away with insider trading. She had built her brand on trust and reliability. People believed what she said because they trusted her opinion. But here's the irony. The very thing that made her successful, her reputation for honesty, was what got her in trouble when she failed to uphold those standards. But here's another angle. How did the SEC catch Martha Stewart? They identified a pattern of suspicious trading activities, not just focusing on individual investors like her. It involved a combination of timing and meticulous investigation into unusual market activity around the time of significant corporate events. Now let's look at the present day. Insider trading remains a persistent issue, but it's becoming increasingly difficult to get away with due to advanced data analysis tools and stricter regulatory oversight. The SEC is more vigilant than ever before in its efforts to prevent and prosecute such activities. However, the reality is that there will always be individuals attempting to exploit market information for personal gain. So what can you do? Stay informed and be cautious. Always think twice before acting on any non-public information. Remember, if it seems too good to be true, it likely is. Now let's look at a concrete example of how insider trading affects regular investors. In 2001, Martha Stewart was found guilty of engaging in insider trading when she sold her shares of ImClone Systems based on non-public information. This case shows that even big names can fall from grace and highlights the importance of due diligence for all investors. But here's where it gets interesting. While Martha Stewart faced legal consequences for her insider trading activities, many other individuals involved in such practices often go undetected. They operate under the radar without facing repercussions. However, just because you don't hear about them doesn't mean they're not impacting the market. Now let's talk about something that might surprise you. Insider trading isn't always about huge sums of money. Sometimes it's just a small gain that can still have significant consequences. Martha Stewart sold $27,500 worth of ImClone Systems stock to avoid losing more money. But she didn't anticipate the legal and financial repercussions. But here's what really matters. The lesson from Martha Stewart's case is broader than her individual actions. It underscores the importance of ethical behavior and compliance with securities laws, highlighting how critical it's for everyone to handle inside information responsibly in a world where trust can quickly erode. Now let's look at the long-term impact of this scandal on investors. For many individuals who relied on Martha Stewart's investment advice, the scandal undermined their trust in financial markets and corporate insiders. It led them to question the reliability of information they received about stocks and other investments. But here's a silver lining. The aftermath of Martha Stewart's insider trading case contributed to increased regulatory oversight and greater transparency in financial markets. This is beneficial for everyone as it reduces the opportunities for individuals to exploit information asymmetries within the market. Now let's circle back to why this matters. When someone as influential as Martha Stewart gets involved in insider trading, it highlights issues of fairness and accountability. This case demonstrates that even prominent figures are subject to the same laws and regulations as all other individuals. But here's a critical point. The real victims of insider trading aren't just the people who get caught. They're also regular investors who potentially lose money because they trusted someone with inside information or were at a disadvantage due to it. And while Martha Stewart's case made headlines, many other smaller cases go unnoticed, but still have significant impacts on individual lives and the integrity of financial markets. Now let's discuss how you can protect yourself from insider trading risks. Always verify your sources and never act on non-public information. Conduct your own research and remain skeptical of any information that seems overly convenient or too good to be true. But here's a final thought. While Martha Stewart's insider trading case served as a wake-up call for many investors about the importance of integrity in financial practices and advice, it also highlighted the consequences of breaches of trust. When someone you trust betrays that trust, rebuilding can take time but is possible. So remember this, trust is crucial in finance. Whether it's your own reputation or following others' recommendations, always question and verify before investing. After all, as seen with Martha Stewart, the repercussions of insider trading violations can be serious. Insider trading can lead to severe consequences, both legally and personally. It's crucial to adhere to regulations and conduct thorough research before making any financial decisions. This is educational and historical, not financial advice.